Welcome back, everyone. We're taking a deep dive today into the world of finance with this book, Financial Intelligence, by Berman and Knight. It's a guide that aims to make financial numbers a little less, well, scary. And the best part is, you don't need to be a financial expert to follow along.
Exactly. That's one of the things that makes this book so great. It's written for everyone in an organization, from the CEO to, folks on the front lines. And it really emphasizes how understanding, even the basic financial stuff can help people make better decisions no matter what their role is.
So before we really get going, can you give us a quick intro to who these authors are, just so we have some context?
Sure. So Berman, she's got that academic background, spent a lot of time researching how financial literacy, or I guess the lack of it, impacts company performance. And Knight, he's more the hands-on, practical guy, CFO experience. He learned a lot, sometimes the hard way, at a company called SetPoint. They make roller coasters and factory automation equipment. Pretty interesting stuff.
That's an interesting combo. So the book's premise is what really got me hooked. It's not just about learning accounting rules, right? It's more about deciphering what the numbers are actually trying to tell us. It's about why profit doesn't always mean you're rolling in cash, or how companies kind of strategically present their financials, know? And this idea of ratios and how they can reveal hidden insights.
Yeah, you hit the nail on the head. It's about developing the ability to think critically about financial information, to actually understand it, not just memorize definitions.
Yeah.
And then use that understanding to make smarter choices at every level of an organization.
Okay, let's dive right in. What exactly is financial intelligence? If you had to sum it up, really simply.
Financial intelligence is the ability to understand what those financial numbers actually mean, how they impact decisions, and how they ultimately affect a company's performance, its success. Basically, it's about making informed decisions without needing to be a certified accountant.
I love how the book uses real-world examples to make this point. There's a story about a manager who actually got a raise by using financial data to prove their value to the company.
Right. And that's a great example of how financial intelligence can empower people. It gives them the knowledge and the tools to understand, what they bring to the table and to advocate for themselves more effectively.
Okay, this is where things get interesting for me. The book calls accounting and finance an art. That seems kind of counterintuitive. I mean, aren't numbers supposed to be objective?
Well, yeah, finance definitely relies on data, but there's also a lot of estimation involved and subjective choices and even some, maybe even creativity. It's not just plugging numbers into a formula.
And the book gives some great examples to illustrate that point, right? How a company can change the way they recognize revenue to meet earnings targets, or how the way they depreciate assets, even something as basic as a delivery truck, can drastically change how much profit they report. And then there's goodwill, which seems, kind of tricky to value, especially during those boom times like the dot-com era, when companies were being valued based on things like how many engineers they had or how many hits their website got.
Right. And all those examples highlight this key idea that financial data isn't always as clear-cut as it seems. True financial intelligence means understanding the why behind the numbers, what assumptions were made, what judgments were involved in calculating those figures.
Okay, so let's talk about some real-world situations where things went wrong. The book goes into these two fascinating case studies, WorldCom and Tyco International, both from the late 1990s, early 2000s.
Yeah, and those cases are great examples of what can happen when companies have misaligned financial strategies, let's say. WorldCom, they were a huge telecom company that grew through a ton of acquisitions. And they felt this immense pressure to report high profits, to keep their stock price up and maintain access to loans. And, it led them to some questionable accounting practices, to put it mildly.
And then there's Tyco. They faced a lot of scrutiny despite, or maybe because of, their CEO's extravagant lifestyle, shall we say. Their strategy was also very aggressive acquisitions like WorldCom, and that resulted in a lot of goodwill on their balance sheet, which made investors a little nervous.
Yeah, and the rumors that were swirling about their accounting practices, let's just say they didn't help matters. Both these cases really underscore the need to align a company's financial strategies with its long-term health. You can't just chase short-term gains and hope for the best.
Which brings us to a really important point that the book stresses, cash flow. Why is this something that so many people seem to overlook?
Well, it's easy to get caught up in, those big profit numbers you see on an income statement. But profit doesn't always equal cash in the bank. Cash flow gives you a much more realistic picture of a company's financial health. because it focuses on the actual movement of money coming in and going out, and it's harder to manipulate, to make it look better than it actually is.
And the book talks about how Joe Knight, one of the authors, learned this the hard way, right? At Set Point, his company, they were showing good profits, but they were actually running low on cash. It was a real wake-up call that profitability and financial stability aren't always the same thing.
It's like that saying, cash is king. You can't pay your bills or your employees with profit alone. It's the cash that matters in the end.
And speaking of those essential financial reports, let's talk about the three main ones. They can seem kind of intimidating, but the book does a good job of breaking them down, even for people who aren't, finance experts. We've got the income statement, the balance sheet, and the cash flow statement, each giving us a different view, right?
Absolutely. It's like examining a business from three different angles. The income statement tells you how profitable a company has been over a period of time. The balance sheet gives you a snapshot of its assets, liabilities, and equity at a particular point in time. And then the cash flow statement, that tracks the movement of cash both in and out of the company.
I love how the book uses analogies to explain these statements. Like, they compare the balance sheet to buying a house. Your assets are the house itself, your liabilities are the mortgage, and your equity is your stake in the property. It's a simple but really effective way to understand what these reports are telling us.
Analogies are great for making these complex financial concepts a little less intimidating, right? The point isn't to get bogged down in the jargon. It's about understanding those core principles.
So we've already covered a lot of ground. We've defined financial intelligence, talked about why it matters for everyone in a company, discussed the surprising, art of finance, and even dipped our toes into the world of financial statements.
And we've looked at some examples of how things can go wrong when companies have misaligned financial strategies or, in some cases, engage in outright fraud.
But don't worry, we're just getting started. Coming up next, we're going to dive into the world of financial ratios, those secret codes that can unlock even deeper insights from financial statements.
We'll explore how ratios can reveal compelling stories about a company's performance, showing trends that you might not see just by looking at the raw numbers themselves.
So stay with us. We've got a lot more to explore on our journey into the world of financial intelligence.
Welcome back to our exploration of financial intelligence.
Now, before the break, we were about to get into these things called financial ratios. And I have to admit, when I first started learning about them, I kind of zoned out. They seemed like, something only accountants needed to worry about. But this book really makes the case that ratios can be useful for, anyone.
Oh, absolutely. Ratios can take all that raw financial data and turn it into something meaningful. They help you go beyond just looking at isolated numbers and start to see the connections, relationships, the patterns hidden within those numbers. They're keys to unlocking the financial landscape,
So instead of just knowing a company made, let's say, $5 million in profit, ratios help us understand if that's actually good or bad, or just, average.
Exactly. Ratios provide context. Is $5 million a lot for a huge company? Probably not. But for a small startup, that could be amazing. Ratios help us make those kinds of comparisons. They show us how a company is performing relative to its size, its industry, even its own past performance.
Okay, I'm starting to get it. But there are so many different ratios. Which ones are the most important for someone who's not a financial expert to know? Say, a marketing manager or a sales director?
Well, let's start with profitability ratios. These focus on a company's ability to make money from its core operations. One of the most basic ones is gross profit margin. It tells you how much profit a company makes for every dollar of sales after they've paid for the direct costs of producing their goods or services.
So if a company sells a product for $50 and it costs them $30 to make, their gross profit margin would be 40%. That seems pretty easy to calculate.
Yeah. And if you track this ratio over time, it can give you valuable clues. Is the company getting better at controlling those production costs? Are they negotiating better deals with their suppliers? Or streamlining their manufacturing processes? The gross profit margin can kind of hint at those kinds of operational improvements.
I see. You can really start to paint a picture of what's going on behind the scenes with these ratios. Are there other profitability ratios we should know about?
Yeah, another important one is operating profit margin. This one takes a broader view. It includes all operating expenses, not just the direct costs of production, so things like rent, salaries, marketing, that sort of thing. It shows how much profit a company has left for every dollar of sales after covering all those necessary expenses.
So it's a measure of how efficient the whole business is, not just the production side of things.
Right. And this ratio is really relevant for managers because they typically have more control over those operating expenses. It's something they can actually influence through the decisions they make.
Got it. So we've covered profitability ratios. What other categories should we be aware of?
Next up, leverage ratios. These look at how a company uses debt to finance its operations. Now, debt's not necessarily a bad thing, right? It can actually be a useful tool for growth. It lets companies invest in new projects or acquire other businesses.
It's like using a mortgage to buy a house. Most people can't just buy a house outright, so they use debt to help them make that purchase. Companies can do the same thing.
Exactly. But just like with personal finances, it's important to make sure you're not taking on too much debt. Leverage ratios help us figure out if a company is relying too heavily on borrowed money compared to its equity. One of the key ratios here is the debt-to-equity ratio. It compares a company's total debt to its shareholders' equity.
So if a company has a debt-to-equity ratio of 1.5, that means they have 1.5 times more debt than equity financing their operations.
You got it. A high debt-to-equity ratio isn't always a bad thing. But it can be a red flag that a company might be more vulnerable if, the economy takes a downturn or interest rates start to rise.
Makes sense. Any other leverage ratios we should keep in mind?
Yeah, the interest coverage ratio is another important one. This one tells you how easily a company can cover its interest expenses with its earnings. Basically, it shows you if they're comfortably able to make their debt payments.
So if their earnings take a hit, can they still pay the interest on their debt without having to, cut back on other important things?
Exactly. It gives you a sense of how much financial cushion a company has.
Okay, we've covered profitability and leverage ratios. Where do we go from here?
Liquidity ratios. These are all about a company's ability to pay its short-term bills on time. Can they meet those obligations without running into cash flow problems?
I imagine this is especially important for, smaller businesses or startups that might not have a lot of cash reserves.
Definitely. One of the most common liquidity ratios is the current ratio. This compares a company's current assets, things they can quickly turn into cash, like their inventory or the money customers owe them, to their current liabilities, the bills they have to pay in the near future.
So if a company's current ratio is 2, that means they have twice as many assets that can be easily turned into cash compared to the bills they have to pay soon. That sounds like a pretty good position to be in.
It is. A good current ratio suggests a company has a buffer, They can handle their short-term obligations without too much stress. But if that ratio starts to get too low, it could signal potential cash flow problems down the road.
Okay, that's a warning sign no business owner wants to see. Any other liquidity ratios we should be aware of?
The quick ratio, sometimes called the acid test, is another important one. It's similar to the current ratio, but it doesn't include inventory.
Wait, why not include inventory? Isn't that considered a liquid asset? You can sell it to generate cash.
Yeah, but selling inventory can take time, right? You have to find buyers and actually get the goods to them. The quick ratio focuses on the most liquid assets, like cash on hand and money that's owed to the company that's likely to be collected very soon. It gives you a more conservative view of whether a company can really cover those immediate bills.
So it's kind of like a worst-case scenario test. Can they still pay their bills even if they can't sell their inventory right away?
Exactly. It shows you how resilient a company is in the face of those short-term challenges.
Okay, so we've talked about profitability ratios, leverage ratios, and liquidity ratios. Are we missing any other big categories of ratios?
One more. Activity ratios, which are sometimes called efficiency ratios. These are helpful for understanding how effectively a company is using its assets to generate sales.
Efficiency ratios. What do those tell us?
Well, for example, the inventory turnover ratio tells you how many times a company sells and replaces its inventory over a specific period of time.
So if a company has a high inventory turnover, that means they're selling their products quickly and not letting them just sit around on shelves where they could become outdated or even go bad.
You got it. A high turnover is usually a good sign. It means they're managing their inventory well, which can free up cash to reinvest in the business, and it reduces the risk of having, obsolete products.
That makes sense. What other activity ratios should we be paying attention to?
Day sales outstanding, or DSO, is another one. It measures how long it takes a company to collect the money that customers owe them after they've made a sale.
Oh, okay. So a lower DSO means they're collecting their receivables efficiently, which, again, is good for their cash flow.
Right. The faster they collect that money, the more cash they have to cover expenses, invest in new things, or even return to shareholders.
Wow, we've really covered a lot of ground in the world of ratios. It's amazing how much information you can get from these calculations. I'm really starting to see why the book emphasizes them as a key part of financial intelligence.
It's like having a special decoder ring to help you understand the stories hidden within those financial statements. And as we've seen, understanding these ratios can be really useful for anyone in a company, not just the finance team.
Absolutely. Whether you're in sales, marketing, operations, HR, wherever, knowing these key financial ratios can help you make smarter decisions that ultimately contribute to the success of the company. It's all about connecting the dots between your work and the overall financial health of the business.
And don't forget, ratios are just one piece of the puzzle. We need to look at them in the context of the company's industry, its competitors, its overall strategy. They're tools to help us understand the story, but they're not the whole story.
Okay, I feel a lot more confident about ratios now. What's next on our agenda?
Let's shift gears now and talk about capital expenditures and ROI. This is really important for managers who are making decisions about, investing in the business.
Capital expenditures. That sounds a bit intimidating. Are we talking about those big investments that companies make, like building a new factory or buying expensive equipment? Things that are supposed to benefit the company for many years.
You got it. Capital expenditures, or CapEx, are those big chunks of cash that a company spends with the hope of getting a return on that investment over a long period of time. And to make sure those investments are wise ones, we need to understand the concept of return on investment, or ROI.
ROI, that makes sense. You want to make sure those investments are actually creating value for the company.
Yeah.
But how do you calculate ROI for something like building a new factory?
Well, there are a few different methods. The book goes through three of the most common ones: the payback method, the net present value method, NPV, and the internal rate of return method, IRR.
Okay, let's break those down. The payback method seems pretty simple. Is it just calculating how long it takes for an investment to generate enough cash flow to cover the initial cost? Like, how long until the investment pays for itself?
Exactly. The payback method focuses on how quickly an investment starts generating positive returns.
So if a new piece of equipment costs $500,000 and it's projected to generate $100,000 in cash flow per year, the payback period would be 5 years.
Right. Now, the payback method is easy to understand, but it does have some limitations. For example, it doesn't factor in the time value of money. Like, $1 today is worth more than $1 5 years from now because of inflation. And it also ignores any cash flows that happen after the payback period, so you might miss out on seeing the long-term profitability of an investment.
Ah, okay. So it's a good starting point, but it's not a complete picture. What about the net present value NPV method? How is that different?
The NPV method takes into account that time value of money that the payback method ignores. It recognizes that money you receive in the future is worth less than money you receive today.
So it's a more sophisticated way of looking at those future cash flows.
Exactly. It discounts those future cash flows back to their present value using a discount rate that reflects, the minimum return the company expects to earn on its investments. And then it subtracts the initial cost of the investment from the sum of those discounted cash flows.
So if the NPV is positive, that means the investment is projected to make more money than the company's minimum acceptable rate of return.
That's right. A positive NPV suggests a good investment, while a negative NPV is a warning sign that maybe the investment isn't worth it.
Got it. And what about the internal rate of return, IRR? How does that one work?
The IRR is the discount rate that would make the NPV of an investment equal to 0. Basically, it's the effective rate of return that the investment is expected to generate.
So if a project's IRR is higher than the company's minimum acceptable return, that's a good thing.
Exactly. It suggests the project is likely to be profitable.
These methods for evaluating CapEx seem pretty thorough. But the book also talks about some cases where, even with all this analysis, companies made some terrible investment decisions.
Yeah, the story of Chainsaw Al, Dunlap, and Sunbeam is a classic example. It shows how a company can manipulate its financial reporting to create this illusion of success, even when there are serious problems lurking underneath.
Right. Dunlap got his nickname because of his ruthless cost-cutting. And initially, it seemed like he was turning Sunbeam around. Profits went up, investors were happy, but as we learn in the book, his tactics were more about creating a short-term illusion than building a sustainable business.
He was playing accounting games, like using bill and hold sales practices and manipulating reserves to make Sunbeam's earnings look much better than they actually were.
Hold on. What are bill and hold sales?
It's when a company records revenue for products before they've actually shipped them to customers. So they're basically booking sales they haven't earned yet. It's misleading, to say the least.
So they were basically trying to trick investors into thinking the company was doing better than it really was.
Pretty much. And while those kinds of tricks might work for a little while, they can't hide the truth forever. And when the truth about Sunbeam came out, it was a disaster.
It's a good reminder that financial intelligence isn't just about understanding numbers. It's about being critical, questioning assumptions, and thinking about the long term.
It's about seeing the whole picture.
Right. So we've explored financial statements, ratios, and the challenges of evaluating capital expenditures. What else does the book have to offer on this journey to becoming more financially intelligent?
Well, one of the key themes in the book is the importance of building a financially intelligent organization. It's not enough for just the finance people to understand this stuff. Everyone in the company should have a basic understanding of the financials.
That makes sense. If everyone understands the financial side of the business, they can make better decisions no matter what their job is.
Exactly. The book talks about creating a culture of financial literacy where financial information is shared openly and everyone is encouraged to participate in discussions about the company's performance.
That's a big shift from that old school corporate culture where financial information is this big secret that only a few people have access to.
It is a shift, but it's a good one. When employees understand the financials, they become more invested in the company's success. They feel a sense of ownership and accountability.
Instead of feeling like they're just cogs in a machine, they can see how their work actually impacts the bottom line.
Exactly. And that can be really powerful.
So how can companies actually make this happen? How do they create that kind of culture?
The book has some good suggestions, like doing regular training sessions and having weekly numbers meetings where everyone can discuss key performance indicators, and using visuals like scoreboards or financial maps to make the information more engaging.
I like the idea of using visuals. It's one thing to hear about numbers, but actually seeing them can make a big difference, especially for people who aren't naturally, numbers people.
Visuals are great for making financial information more accessible to everyone.
We've covered so much today: financial statements, ratios, capital expenditures, and building a financially intelligent organization. Where do we go from here? What's the final takeaway from the book?
The book ends by talking about the importance of financial transparency, especially after all those big corporate scandals like Enron and WorldCom.
Right. Those scandals really shook people's trust in businesses. And now there's this expectation for companies to be more open and accountable.
People want to know how companies are doing financially, where their money is going, what risks they're taking.
It makes sense. So how does this translate into action? What does financial transparency actually look like?
For publicly traded companies, it means going beyond just the bare minimum legal requirements. It means giving investors clear and easy to understand information about the company's financials, being upfront about risks and challenges, and really engaging with shareholders.
It's about building trust. And internally, within the organization, what does financial transparency look like?
It's about creating a culture of openness, sharing financial information with employees, helping them understand how the company makes money, how their job contributes to that, and how the company's financial performance impacts them.
Empowering them to make informed decisions, right?
Exactly. It's about working together as a team. So we were talking about this idea of financial transparency, and, it's becoming more and more important these days. It's not just a nice to have anymore.
It really feels like it's becoming an expectation. Like employees want it, investors want it, even the general public wants companies to be more transparent about their financials.
Yeah, I think people have a right to know, right? Especially after all those scandals we talked about earlier, Enron, WorldCom, Tyco. Those cases really eroded people's trust in corporations. And one way to rebuild that trust is through greater transparency.
Okay, so how do companies actually do that? How do they become more transparent?
Well, for publicly traded companies, it means being more than just compliant. It's not just about checking the boxes and making sure you're following the rules. It's about making a real effort to communicate clearly with investors, giving them financial information that they can actually understand, being upfront about risks, having a real dialogue, not just talking at them.
It's about building real relationships, right?
Yeah.
Based on trust and open communication, not just, doing the bare minimum. And what about internally? How can companies be more financially transparent with their own employees?
That's all about creating a culture of openness. It means sharing financial information with employees in a way that makes sense to them, explaining how the company makes money, how their work contributes to that, and how the company's financial performance impacts them personally.
So it's about empowering them, right?
Yeah.
Giving them the information they need to make good decisions, not just for the company, but for themselves.
Exactly. When people understand the financials, they feel more connected to the company's success.
It's a win-win. Okay, so as we wrap up our deep dive into financial intelligence, let's go back to those key takeaways, those 10 principles that we pulled out of the book.
Sounds good. It's a lot to absorb, so having a concise summary can be really helpful.
Okay, so principle number 1, what is it?
Financial intelligence is for everyone. You don't need to be an accountant to benefit from it. It's a valuable skill set for anyone in any role in any industry.
It's about taking ownership of your financial understanding. Okay, what's next?
Principle number 2. Those 3 financial statements, the income statement, the balance sheet, and the cash flow statement, they're your foundation. Learn those, and you'll be well on your way to understanding how companies work.
Those are the building blocks for sure. What's number 3?
Profit doesn't always equal cash. Cash flow is king. You gotta pay attention to the actual movement of money, not just the numbers on a report.
It's about being realistic, right? Not getting caught up in those, accounting illusions. What about principle number 4?
Accounting and finance aren't just about the numbers. There's a human element to it. Estimations, assumptions, judgment calls.
So it's not as black and white as it might seem, right? Okay, number 5.
Ratios. Ratios are your friends. They help you unlock insights and see trends that you wouldn't notice just by looking at the raw numbers.
They're like a secret decoder ring for financial statements. All right, what's next?
Principle number 6. Managing the balance sheet effectively is critical, especially those working capital items like accounts receivables, inventory, and accounts payable.
Keeping that cash flowing smoothly. Okay, number 7.
Capital expenditures need to be evaluated carefully. You got to make sure those big investments are actually generating a return.
ROI, return on investment. Makes sense. What about principle number 8?
Chainsaw Al Dunlap and Sunbeam. A classic cautionary tale. Don't manipulate the numbers for short-term gain. It'll catch up with you eventually.
Integrity matters. Okay, principle number 9.
Create a culture of financial literacy within your organization. Make sure everyone has a basic understanding of the financials.
Share the knowledge. And last but not least, number 10.
Financial transparency, both internally and externally, is essential. It's the foundation of trust.
It's the way forward. So there you have it, folks. 10 key principles of financial intelligence.
A roadmap to help you make smarter financial decisions and navigate the complexities of the business world.
It's been a great discussion. Thanks for joining us for this deep dive into financial intelligence.
It's been my pleasure.
And remember, this is just the beginning of your journey. Keep learning, keep asking questions, and keep exploring the fascinating world of finance. We'll see you next time.